So today I thought I'd talk about two UK stocks that have crashed a big amount. So we're going to talk about Hotel Chocolate and Feathertree and talk about these two stocks and if there are opportunities to be buying them after the crashes that they have been on after trading updates. So I was only a few days ago I was talking about the UK stocks. The UK stocks seem to be struggling a little bit. Not too bad on the US side. We're having a bit of a rally at the moment. We'll keep that quiet. But on the UK side, it just seems like on the last few weeks they've just all kind of gone, we're going to give up. And maybe it's the heat. I don't know about you guys, but all my days it is warm today. If you're from the UK, I am sweating making this video, I'm not going to lie. We're going to get stuck onto these two companies and I'll talk about if there are opportunities to be buying them. So, you know what? Let's start with Hotel Chocolate. This is actually one that I own. I own the first one, I don't actually own the second one. And also, have you noticed this recently about Google? I don't know if you guys are having the same problem. I don't know if it's just me, but when you use Google Charts, it just seems to be glitching out. Like if you go on like year to date, 6 month, 1 month, I don't know what it is, but it just seems to be glitching out on Google Charts, so I'm not sure. It seems to be working on the 1 day anyway. Actually, I think it works on it works on the 5 day as well, which is really weird. Don't know if any of you guys are having that problem as well. You can see here that we're currently down 44%. As it kind of opened up, the stock actually kind of just kept trickling downwards, like 15%. The stock was actually halted twice, I believe, today. And then around about lunchtime, there's actually a few buyers coming in. So it has had a bit of a rally. It was actually down 50% at its peak, and then it kind of rallied up 44%. I'm not going to lie, I was very tempted to buy myself today. I'll talk about potentially what I'm doing towards the back end of when I get to Hotel Chocolate. But yeah, I was tempted myself to kind of come in here. It does put it down at 14 times earnings. Now, this is a little bit of a tricky one because when we get onto this update, you'll actually see that the earnings at the moment is actually going to be skewed slightly because of some store closures. But if it wasn't for that 14 times earnings, and also probably is going to trade at a little bit of a higher P ratio in the next financial year, and then it's going to recover slightly. But we'll get onto that when we actually go through this update that they did release. But you'll see here that actually, if we go on the max chart, this actually puts it at the lowest it's ever been since its IPO. Now there has been some share dilution here, so just be aware of that one. But on a price wise, it is lower than when it IPO'd back in 2016, which you can see here that when Hotel Chocolate came on the AIM, you can see that it came on at a valuation of 55 million. So like I say here, it's actually still valued like I think this is updated, 177 million. So you can see here, that's why there's a disconnect here, that it's lower, but it's not actually low on the market cap. It's because of the share dilution that's happened. You can see it has been quite a bit of a drop off here. Now going into the trading update. Now, originally I opened up my account and I went, whoa, what has happened to Hotel Chocolate today? I originally did that and I thought there must be some news out here, and I was like, okay, it's a trading update. And I actually opened up the trading update going, okay, it actually looks pretty good. 52-week period ended 26th of June 2022. Total group revenue increased by 37%. I thought, fantastic, that's growing absolutely massive rates, ahead of market consensus expectations. So thinking, okay, this is great. Something in here has caused a big massive drop. And by 70% compared to the financial year ended 30th of June 2019, even beating pre-CV numbers by a massive amount. Same again with financial 19 being the last full equivalent year period. And then same again, H2 growth remained very robust at 32% against stronger comparatives in Q4 financial year 2021 at the end of lockdown. Same again, I'm thinking, okay, everything in here is positive. And you can see here the performance compared to financial year 21 or financial year 19, it's really positive. And then the next part was about the profit, and you can see here that it said the board anticipates underlying financial year 22 profit to be before tax to be in line with market consensus. I'm thinking, okay, so the revenue is massively ahead where it should be, but even the profit's coming in line. I've still not got to the point where it's been dropping here. But then it said the statutory report profit for financial year 2022 is expected to be a loss, being affected by the outcome of internal business review, predominantly as a result of non-cash impairment provisions and costs arising from discontinued activities, including the closure of retail stores in the US. So boom, straight away from that point of view, we've got, okay, this is why the drop is happening. A bit further down here, it said the group will now deliberately focus on the efforts over the next 3 years on its most proven and low-key risk strategies with the greatest potential for further increased profitability and scale cash generation. The forward strategy for each of the 6 growth drivers as follows. So very much it sounds like, okay, we're going to stick to what we know. We're going to be focusing on the UK market a lot more. And from that, we're going to draw more profitability from them. And that's where the margins will be better and will generate more profit. So you can see here that very much it was kind of, we're going to slow down international expansion, focus on the UK, get more profitability out there. So straight away thinking, okay, US and Japan is where the growth area was going to be. So the growth or the revenue is going to slow down. At the same time, that also means they're going to be looking to generate more profit. So you can see here, this is the profit margins here. You can see they've, historically held, 4, 5, all the way up to 8% in profit margins. And you can see here, like, it started to drop down to a 6. So they're pretty much saying that we're going to focus on here and get these profit margins up and generate more profit from these sort of markets. The focus on profitability drivers will mean lower sales growth in the short term. Obviously, that means they're focusing less on the international part of it, and some transitional costs leading to lower profits in financial 23. So basically coming out and saying that the financial 23 profits will be lower than what is expected from the market, with the objective of higher profits thereafter and a strategic goal of 20% EBITDA pre-IFRS 16 in financial year 25. So you can see here they're basically saying, okay, we're going to drop down in profit in financial year 23, but actually we should see the returns in this in the kind of next 2 or 3 years. They should generate more profit and better margins for us. Current cost headwinds including OPEX investments and inflation together with mitigations as set out in the table below. And you can see here that what they actually trying to pursue here with the likes of the Velvetizer and more alcohol Velvetizers, online business, profitability from the UK market. And it also sounds like they've had some costs on the material side of it, and that will also hoping for that to kind of calm down in the next kind of few years as well. Now, it says here the group has decided to adopt a de-risk approach to international growth opportunities, and in financial 23 they fund necessary working capital only without making speculative investments in customer acquisition or capex. The US focus will become solely online and wholesale when the one remaining store closes in H1 financial year 23. So that's quite interesting because it sounded like the international focus was dead, but the fact they're actually still going, okay, we're actually still going to stick in the US side of it, we're actually going to do it just online only, it's the actual retail print that's going to actually close down. I actually like that. Even though one of the big reasons for the growth in the future was the international part of the business, that they're still going to be in the US is good because you've still got the online presence. Online presence will also lead to better margins as well than the actual retail footprint, and we've seen the growth in the online side of it, in the UK side of it. So yeah, even though it's going to take a little bit of a hit in the next 2 years, I'm actually not too fussed about that because they're still going to try and get it to work out. Obviously it's a bit of a hit in the short term, but I was like, okay, fair enough. It's not great news in the short term, but it's not terrible. And then the Japan side of it, same again. They go on about the COVID restrictions. It sounded like they're currently looking at the situation in Japan as well. So we'll see what happens there. This is from Angus Terwell, by the way, which is the co-founder, the biggest shareholder of the company. While we expect a temporary lower sales growth rate and profitability margin in financial year 23 as we carry on through our adjustments, so we know there's going to be hit in 23, like we said earlier, the result will be a business delivering greater results. So, this is the great thing is like, they're basically coming out and saying, look, we are going to, this will benefit us in the long term because we are going to make, more profitability. It's questionable about the revenue side of it, but yeah, it could lead to more profitability in the long term with less risk and even stronger balance sheet with higher profit percentage growth in financial year 24 and 25. So yeah, basically a big hit in 2022 and 2023 as the adjustment slowdowns from more aggressive in that US, but we should see the rewards in 2-3 years time. So yeah, overall I was like, yeah, I can see why there's some hurt on the stock price, but it wasn't the worst thing. Like, the results were good and they're still kind of involved in that international space. And it sounds like in the longer term, yeah, the international business hasn't lived up to what we were hoping for, but they're still giving it a go with the online presence, and we'll see what happens. But you got to remember, like, a majority of the revenue is from the UK side anyway. And then when you look at the past performance, this is mostly from the UK markets. It's got a history of driving that profit up, growing that revenue. Future growth wise, you can see this is the future growth. Obviously, this is going to get analysts correcting this over the next few months. So we're probably going to see slower profit, in this time frame. But we're going to see great amounts of profit in the future years, hopefully better profit margins. And revenue growth, even though it probably won't be what is going to be expected here, from the company. It's still going to be high, kind of, you know, well, not high, but kind of the mid-low single digits, which is still pretty healthy. And, you know, financial health wise, it's still pretty strong on the balance sheet. It's, you know, there's no debt on there. It's got plenty of cash. You know, we've still got a, you know, founder-led company. You know, Angus Terwell is still owning 27% of the business, which is absolutely fantastic. And I'll actually be really happy if he comes out and buys shares in the next few days. But overall, I looked at the share price correction on Hotel Chocolate today, and I was like, okay, we're having a 50% correction on them results. Like, yeah, sure. I understand there's a bit of market unhappy because they're not, you know, it sounds like, you know, the international growth is slowing down, meaning there's going to be less growth. But in the longer term, if that can generate more amounts of profit and still make a good kind of business out of that online presence in the US, it's still going to be a high quality company. Like, it doesn't deserve to be, you know, trading down at 14 times earnings at the moment, and that 50% sell off. So, you know, overall, my opinions on Hotel Chocolate, you know, I think this is a, you know, a premium company, should trade up at 20 times earnings. You know, you start running a, let's say, a 3-4% growth on this company in the next 5 years. I still see 100% return from this company. So now that this stock has fallen off so much, yeah, I actually think, like, I understand it deserves to have probably something like a 20% drop today, but not a 50% drop. I think in the next few weeks we should see this bounce up a little bit. I think this was a ridiculous sell-off. So I am going to be buying shares in Hotel Chocolate at some point, more than likely next week. We'll see what happens. So yeah, I've not bought any yet, but I probably will do, just because I've already bought my stocks for this week. But I think this is a pretty interesting opportunity out there. The next one is Feathertree. And this is future me just to apologise, because what you will see me do in this video a couple of times is, instead of saying Fevertree, I say Feathertree. And yeah, so just so that you know about that, and apologies for doing that in this video. So anyway, we'll get on to it. Now, I actually had a few of you guys actually commenting on my videos, like, can you talk about it? Can you mention the stock? So yeah, here we go. We're doing it today. So yeah, Feathertree is at the lowest valuation now on a stock price point of view since, let's have a look, 2016. So that is a massive pullback on this one. It's a 1 billion company, 26 times earnings, does pay a dividend, 1.5% dividend yield. And you probably know this, it's a producer of premium drinks mixers. And same again, they brought out a bit of a trading update. And by the way, this is the worst age verification I've ever seen on a website. It was literally, are you over 18? Yes, it ticked the box. Anyway. Not that it matters to me, but hey. So yeah, same again, these guys brought some earnings out, or was it a trading update actually? Let's just have a quick look. It was a trading update, yes, on the 15th of July. So yeah, I looked at this and it came out that, same again, it was financial year 2022 to the 30th of June. Numbers look strong, UK 6%, US 11%, Europe 27%, which is pretty good. Rest of the world 7%, total 14%. Thinking, yep, it's pretty solid growth. So all good on the revenue side of it, and it's maintaining its revenue guidance. Then it came out with this little part. This little part is probably what caused most of the drop. The impact of logistics and cost of headwinds prevailing across the industry have significantly worsened in recent months. We know, obviously, that's what's happening in the world right now. And we now anticipate gross margins of 37% and EBITDA margins of 14% for the first half. We expect this to continue to impact the business during the second half. So obviously guidance then coming out saying, actually, it's still not getting any worse, resulting in revised EBITDA guidance between 37.5 million and 45 million for the full year. So I think they basically came out with profit margin, profit warning. Basically, I think the profit was down. Overall, I think that will make them something like a third down on the profit, and that's why the shares slumped off this news here. And they basically did say, like, the demand's still strong, which is great. It actually came in on the US, and it actually came out and said, like, the demand is actually so good in the US that we're struggling to, like, supply the demand, which is always a positive sign. Like, this, it's always so much better to have a profit affecting you that is not in your control, because that can be resolved. You know, that will level out and that will resolve itself. The bigger problem to have is the sales, a shortage of sales demand. If you don't have the sales demand, that's always a worrying thing, but they're actually coming out and saying, look, demand's there. It's just logistic issues that's killing us, like nearly every company out there. So it's actually not that bad at all. Even though the profit will be down, I think they could potentially sort this out. They came up with the financial year 2022 outlook, basically saying one of the things they said is labour shortages have impacted the US East Coast, and also more exposure to sea freight with increasing rates by up to 50% since the start of the year on key routes. You know, we've seen this from so many UK companies. I mean, look at Boohoo, for example. Glass availability has become severely restricted, which has limited opportunity to deliver upside to revenue despite strong demand. That's a pretty positive thing, because glass availability will resolve itself. Demand is, you know, as long as it's got demand there, that's great. Further industry-wide cost pressures have increased, most notably glass costs, where we will see double-digit increase for H2 alongside continual logistic issues, our costs increasing as well, and disruption. So yeah, looking at these results, I thought they weren't terrible. Like, it's good revenue. Sure, there's some profit issues at the moment, and when you look at the share price point of view, I think on the day, I mean, if we can just have a look here, it was down 27%. And actually since then, it's actually recovered 20% of that dip. So yeah, overall, I think the reason why Fevertree had such a dip is I don't think it was as much as an unjustified dip as Hotel Chocolate, but I think it was a bit of an overreaction, and that's probably why it bought in. I also think the thing you got to consider, at 26 times earnings, this company does trade at a little bit of a premium. You know, we're talking about Hotel Chocolate's down at like 14 times earnings. This is 26, you know, it's over nearly double, or it's nearly double what Hotel Chocolate is. So I think that the issue is that they came out with a profit warning, and maybe a lot of the big correction here was because it trades at a premium. I think that's probably the reason why it had such a bit of a pullback. I think like this pullback was a little bit unjustified, and if you did pull that trigger on Friday, I actually don't think that's a bad valuation. So I would say congrats if you bought on Friday. I think that was not too bad of a valuation to be buying this company at. So I think you've done a good job there. I've got to say now on Tuesday, I think paying 26 times earnings for this company is a little bit of a premium. So personally for me, I won't buy it. If I was to buy it, I think this was a good area to be buying this stock. Same again, you do also collect a 1.5% dividend yield on this company. And when you look at the past performance of this company, it's a quality company. You know, you look at the growth of the company. The only little concern I have is the profit margin decline that you've seen here at the moment. It'd be good if they get back to these sort of rates where it's like 20% profit margins. That'd be really good if it can do that. But I mean, it's got a history of really good revenue growth, good profit growth. You know, balance sheet wise, it's solid. You know, it's no debt on the balance sheet. It's very healthy. You know, 166 million sitting on cash. Obviously pays a bit of a dividend as well, which is really nice to collect up with this one. And ownership wise, you know, co-founder, is CEO, big stake in here, a lot of insider buying. What was another positive as well is the CEO actually came out and bought 1 million shares on this drop, which is a really positive sign. Boohoo, hope you're looking at this. So yeah, it was really good to see that. That's really big confidence for the shareholders. So yeah, my only concern with Fevertree is that what it's kind of in is obviously more of the gin space. My worry would be is if the gin space slows down, because it has been on a very big boom in the last few years. My worry would be if that does slow down. That would be my only concern at the moment, and I'd be very cautious of that. So, you know, with that considered, like I said before, for me, Fevertree at this valuation at 26 times earnings, I personally would not be buying that. However, I've got to say, like I said earlier, the people that did jump in and were brave on that Friday when it dropped, I think that sort of valuation around that £8 mark is, and actually it did touch 50-week lows of £8, 4 pence. Around the £8 to £8.40 mark, if it can carry on holding, you know, 8%, 9% revenue growth year by year, also puts that into like the profit growth, and that recovers that logistic issue side of it. And as well as that, you know, one of the key things for Fevertree would be to kind of get back to these pre-pandemic levels of like 20+% profit margins. You know, if it gets up there, like, this is really good. So yeah, overall, not my favorite at these levels. Kind of wish that, I mean, I say I kind of wish, but there's so many opportunities out there to buy. You know, I kind of wish I did take maybe this opportunity on Friday, but there's so many things out there to be buying out now. It is ridiculous. So yeah, that's my thoughts on it. I like it, but I like it at a better valuation. And I think if you were buying that on Friday, I think that was the valuation I like, and unfortunately, kind of miss it. You never know, it might come back, but I think it was a bit of a too good evaluation to be true on Friday. So yeah, well done if you did capitalise on that, I think. So yeah, those are my thoughts on those two companies. Hope you enjoyed it anyway, covering some of the UK stocks as always. If you enjoyed it, hit that like button. If you're new, subscribe, and I'll see you on the next video.